Every single day Bitcoin miners around the world collectively earn 3.125 Bitcoin per block, currently worth hundreds of thousands of dollars, just for solving a mathematical puzzle, and the Bitcoin network processes a new block every 10 minutes, 24 hours a day, 7 days a week, 365 days a year, without ever stopping. In 2026 the total computing power dedicated to securing the Bitcoin network has crossed 1 zettahash per second, which is 1 trillion gigahashes, making it the most powerful computing network ever created by human beings. But what exactly is Bitcoin mining? How does it actually work? Who are the miners? What do they earn? And most importantly, is it still possible for ordinary people to participate in 2026? In this video I am going to answer all of these questions in simple language that anyone can understand. By the end of this video you will have a complete understanding of Bitcoin mining from first principles. Let's get into it. Before we explain how mining works, we need to understand why mining exists in the first place, because the reason is not just to create new Bitcoin, it is something much more fundamental. Bitcoin is a decentralized digital currency. This means there is no central bank, no government, and no single company that controls it. But if there is no central authority, how does the network agree on which transactions are valid and which are not? How does it prevent someone from spending the same Bitcoin twice? This problem is called the double spend problem, and it is one of the most important challenges in computer science. Bitcoin solves this problem through a mechanism called proof of work, which is the technical name for what we call mining. Here is the simplest possible explanation. Imagine a competition where thousands of computers around the world race to solve a specific mathematical puzzle. The first computer to solve the puzzle wins the right to add the next page of transactions to the Bitcoin record book. This record book is called the blockchain. Once a page of transactions is added and confirmed by the network, it becomes permanent and cannot be altered. The cost of solving the puzzle requires enormous amounts of real-world electricity and computing power. This is what makes cheating prohibitively expensive. If someone wanted to rewrite Bitcoin's transaction history, they would need to redo all of that work faster than the entire honest network, which in 2026 with a hash rate of 1 zettahash per second is practically impossible. This is why Bitcoin is described as trustless and permissionless. You do not need to trust any person or institution. The mathematics and the energy expenditure guarantee the integrity of the system. Now let's explain exactly how the mining process works step by step, because understanding the mechanics will make everything else in this video much clearer. Step 1 is transaction broadcasting. When you send Bitcoin to someone, your transaction is broadcast to the Bitcoin network. It enters a waiting area called the mempool, which stands for memory pool. This is essentially a queue of all pending transactions waiting to be confirmed. Step 2 is transaction selection. Bitcoin miners look at the mempool and select which transactions to include in their next block. Miners are economically incentivized to prioritize transactions with higher fees, because they keep those fees as additional income on top of their block reward. This is why during times of network congestion your transaction gets confirmed faster if you pay a higher fee. Step 3 is block construction. The miner assembles the selected transactions into a block. The block also contains a reference to the previous block, which is how the blockchain links together in a chain, and a special field called a nonce, which we will explain in a moment. Step 4 is hashing. This is the actual mining work. The miner takes all of the block data and runs it through a mathematical function called hashrate twice. Hashrate is a one-way function, meaning you can compute the output from the input instantly, but you cannot reverse engineer the input from the output. The output of hashrate is always a 64-character string of numbers and letters called a hash. Step 5 is finding the target hash. The Bitcoin network sets a target that the hash must be below. Think of it like this. Imagine the network requires the hash to start with a certain number of zeros. The more zeros required, the harder the puzzle. The miner changes the nonce value and rehashes the block billions of times per second until they find a hash that meets the target. This process requires enormous computing power and is entirely based on random trial and error. Step 6 is block announcement. When a miner finds a valid hash, they immediately broadcast the block to the entire Bitcoin network. Other nodes verify that the block is valid. If it is, the block is added to the blockchain and that miner receives their reward. The winning miner gets 3.125 Bitcoin plus all the transaction fees from every transaction included in their block. Now let's talk about one of the most important and elegant mechanisms in all of Bitcoin, the difficulty adjustment, because this is what keeps the entire system running smoothly regardless of how much computing power joins or leaves the network. Here is the challenge Bitcoin faces. If more and more miners join the network and add more computing power, blocks will start being found faster than every 10 minutes. If miners leave the network, blocks will start being found slower than every 10 minutes. Bitcoin needs to maintain a consistent 10-minute block time to function properly. The solution is the difficulty adjustment. Bitcoin's difficulty adjustment algorithm recalibrates every 2016 blocks, which is approximately every 2 weeks, ensuring that blocks continue to be found roughly every 10 minutes regardless of how much hash rate is online. The algorithm compares the actual time it took to mine the previous 2016 blocks against the expected time of 20,160 minutes. If blocks came faster, difficulty increases. If blocks came slower, difficulty decreases. The adjustment is capped at a factor of 4 in either direction per period, preventing sudden extreme swings. This mechanism is what Satoshi Nakamoto called the heartbeat of Bitcoin. No matter how many miners join or leave, the 10-minute block time is maintained automatically with no human intervention required. As of June 2026, Bitcoin's current mining difficulty is approximately 138.96 T, with the next difficulty adjustment estimated for June 13, 2026, which is projected to decrease difficulty slightly from 138.96 T to approximately 133.40 T. This self-adjusting mechanism is one of the most brilliant engineering achievements in all of computer science. Now let's talk about what miners actually earn, because this is what drives the entire economic engine of Bitcoin mining. Miners receive 2 types of income from each block they successfully mine. The first type is the block subsidy. In 2026, the Bitcoin block reward remains 3.125 BTC per block, a level set by the April 2024 halving. This reward structure is not influenced by market conditions or miner behavior. It is enforced directly by Bitcoin's protocol and will remain unchanged until the next scheduled halving in April 2028. The second type is transaction fees. Every transaction included in a block pays a fee to the miner. In 2026, fees make up about 10 to 15% of total miner income under normal conditions. This number can increase to 20 to 30% during times of network congestion. Now here is why the halving matters so much. When Bitcoin launched in 2009, the block reward was 50 BTC per block. In November 2012 it halved to 25 BTC. In July 2016 it halved to 12.5 BTC. In May 2020 it halved to 6.25 BTC. In April 2024 it halved to the current 3.125 BTC. And in April 2028 it will have again to 1.5625 BTC. This halving continues approximately every 4 years until all 21 million Bitcoin have been mined, which is estimated to happen around the year 2140. The halving reduces the rate at which new Bitcoin enters circulation, making Bitcoin increasingly scarce over time. This built-in scarcity is one of the core reasons many investors view Bitcoin as digital gold. Now let's talk about the hardware used in Bitcoin mining in 2026, because the technology has changed dramatically since Bitcoin's early days. In 2009 and 2010, Bitcoin mining was done on regular desktop computers using their CPU, which is the central processing unit. By 2011, miners discovered that graphics cards known as GPUs were much more efficient at the repetitive hashing calculations required for mining. By 2013, specialized hardware called ASICs were developed. ASIC stands for Application Specific Integrated Circuit. Unlike CPUs and GPUs, which are designed for general computing tasks, ASICs are built with one single purpose: to mine Bitcoin as efficiently as possible. Today's best machines like the Antminer S21 XP achieve an efficiency rating of 13.5 joules per terahash. The shift from 98 joules per terahash to sub-15 joules per terahash over 8 years represents roughly a 7x improvement in energy efficiency. Today's best machines produce the same output as 7 older rigs using the same power. The current standard for competitive mining hardware in 2026 is a sub-15 joules per terahash efficiency rating. Miners running hardware above approximately 25 joules per terahash found themselves operating at a loss in most electricity markets after the halving. The most important factors for profitable mining in 2026 are hardware efficiency measured in joules per terahash, electricity cost measured in dollars per kilowatt hour, network difficulty, which determines how hard each block is to find, and Bitcoin price, which determines the value of the block reward. Now let's talk about the different ways to participate in Bitcoin mining in 2026 because there are several options ranging from completely hands-off to fully hands-on. Option 1 is solo mining. This means you set up your own ASIC hardware and mine directly on the Bitcoin network yourself. In theory, if you find a valid block, you keep the entire 3.125 BTC reward plus all transaction fees for yourself. In practice, solo mining is only viable for large-scale industrial operators in 2026 because the probability of a single home miner finding a block is extremely low. The current Bitcoin network hash rate in April 2026 makes it hard for small operators to compete, yet there are still cases when a solo miner claims the reward. Option 2 is pool mining. This is the most popular method for individual miners. Pool mining is where miners combine their computational power or hash rate to increase their collective chances of solving a block. Rewards are distributed among participants based on their contribution, providing more consistent payouts. Instead of waiting months or years for a chance at a full block reward, pool miners receive small regular payments proportional to the hash rate they contribute. The largest mining pools in 2026 are Foundry USA and F2 Pool, which collectively control a significant portion of the global Bitcoin hash rate. Option 3 is cloud mining. This involves paying a company to mine Bitcoin on your behalf using their hardware. You pay a contract fee and receive a share of the mining rewards without ever touching physical hardware. Cloud mining has a mixed reputation in the crypto industry. While legitimate cloud mining services do exist, there have been many scams in this space where companies collected fees and never actually mined. Always thoroughly research any cloud mining service before committing funds. Option 4 is Bitcoin ETF investment. For most ordinary investors in 2026, the most practical way to get Bitcoin exposure without the complexity and cost of mining is to simply invest in a Bitcoin ETF through a traditional brokerage account. Bitcoin ETFs now hold over $100 billion in assets and are available through major regulated brokers in the United States. Now let's address the most important question for most viewers, which is whether Bitcoin mining is still profitable in 2026 and whether it makes sense for ordinary people. Here is the honest and complete answer. Mining increasingly favors scale, long-term planning, and strategic energy sourcing rather than short-term speculation. JP Morgan estimated the average industry production cost at approximately $77,000 per BTC, the most efficient miners with sub 5 cents per kilowatt-hour power and the latest ASICs can produce BTC for less than that. Hash price has fallen to approximately $27.89 per petahash per day, and the global 30-day average hash rate has stabilized at approximately 1004 EH per second following recent contraction driven by the decommissioning of older, less efficient hardware. Here is what this means in practical terms for different types of miners. For large industrial-scale miners with access to sub $0.05 per kilowatt-hour electricity and the latest generation ASIC hardware like the Antminer S21 XP at 13.5 joules per terahash, Bitcoin mining can still be significantly profitable in 2026. These are typically large companies with thousands of machines running in purpose-built facilities. Companies like Mara and CleanSpark have responded to the post-halving environment by reinvesting in infrastructure and holding their mined Bitcoin rather than selling it immediately. For medium-scale operations running 10 to 100 machines with electricity costs between $0.05 and $0.08 per kilowatt-hour, profitability depends heavily on Bitcoin's price and network difficulty at any given time. These operations are in the gray zone and need careful ongoing management. For home miners in most developed countries with average electricity costs above $0.10 per kilowatt-hour, Bitcoin mining in 2026 is generally not profitable on a pure economics basis when compared to simply buying Bitcoin directly. The hardware cost, electricity bill, heat generation, and noise make it impractical for most households. So let's bring this all together with everything you need to know about Bitcoin mining in 2026. Bitcoin mining is the process by which new transactions are confirmed and added to the Bitcoin blockchain through a competitive mathematical puzzle called proof of work. Miners collect pending transactions from the mempool, assemble them into blocks, and race to find a valid hash by running SHA-256 calculations billions of times per second. The first miner to find a valid hash wins the block reward, which is currently 3.125 BTC per block as set by the April 2024 halving, plus all transaction fees from the block. Transaction fees make up approximately 10 to 15% of total miner income in 2026 and can rise to 20 to 30% during congestion. Bitcoin's difficulty adjustment recalibrates every 2016 blocks approximately every 2 weeks to maintain the 10-minute block time regardless of how much computing power joins or leaves the network. As of June 2026, Bitcoin's network difficulty is approximately 138.96 trillion, with the next adjustment estimated for June 13, 2026. The total global hash rate has reached approximately 1004 EH per second, making Bitcoin the most powerful computing network in human history. Modern ASIC miners like the Antminer S21 XP achieve efficiencies of 13.5 joules per terahash, representing a 7x improvement over hardware from 8 years ago. For most ordinary investors in 2026, buying Bitcoin directly through a regulated exchange or a Bitcoin ETF is more practical and cost-effective than mining. But understanding how mining works gives you a much deeper appreciation of why Bitcoin is secure, why it is scarce, and why it has value. If this video helped you understand Bitcoin mining, please hit the like button and subscribe to the Crypto Skill for more beginner-friendly crypto education. Drop a comment below and tell me, did you know how Bitcoin mining worked before watching this video?